Welcome back to our series on mastering Forex trading Pitushka FX. In our first video, we covered the basics of the foreign exchange market and some key terms. In this video, we will dive deeper in some important concepts that every Forex trader should know: pips, lot size, spread, leverage, and margin. So, first of all, let's start with our first topic, which is pips. Pips are fundamental unit of measurement in Forex trading. In Forex trading, pips represents the small price movement of a currency pair. For example, if the euro against US dollar currency pair moves from 1.2 to 1.2001, that represents a 1 pip movement. The value of the pip varies depending on the currency pair being traded and the size of the position. For most currency pairs, 1 pip is equivalent to 0.0001 of the quoted price, which is also referred to as a fourth decimal place. However, for currency pairs that include Japanese yen, 1 pip is equivalent to 0.01 of the quoted price, which is referred to as a second decimal place. Pips play a crucial role in determining the profit or loss of the trade. The profit or loss of the trade is calculated based on the number of the pips gained or lost, multiplied by the size of the position. For example, if you buy one lot of the euro against US dollars currency pair at 1.2 and sell it at 1.201, you would have gained 10 pips. If your lot size was 100,000 units of currency, your profit would be $100. 10 pips times $10 per pip for a standard lot. It's important to note that pips are not the same as points. Points are used to measure the price movement in other financial markets, such as stocks or futures. In Forex trading, pips are used instead of points because of the significantly smaller price movements in currency pairs. Moving on to the second topic, which is lot size. Lot size refers to the size of the trade in the Forex trading. The standard lot size is 100,000 units of the base currency. However, not all traders can afford to trade such a lot sizes. That's why Forex brokers offer different lot sizes, such as mini lots, which is 10,000 units, and micro lots, which is 1,000 units. This allows traders to trade smaller sizes and manage the risk more efficiently. The lot size the trader chooses depends on the risk tolerance, trading strategies, and available capital. Traders who are just starting out with Forex trading may prefer to use smaller lot sizes to minimize their risks and gain experience before trading larger positions. It's worth noting that lot size can have a significant impact on the profit or loss of the trade. For example, if a trader buys one standard lot of euro against US dollars at 1.2 and sells it at 1.205, they would make a profit of $500. However, if they had bought one mini lot instead, their profit would have been $50. And if they bought one micro lot, their profit would have been $5. Pretty simple, isn't it? And here's an example with several different positions open simultaneously, each with a different lot size to help you understand how lot size work. Moving on, spread. Spread is another important concept in Forex trading, which refers to the difference between the bid and ask price of the currency pair. And here you can see the example of the bid and ask prices. The bid price is the price at which you can sell a currency pair, while the ask price is the price at which you can buy a currency pair. The spread is the difference between these two prices and represents the cost of the trading. The tighter the spread, the lower the cost of the trading. Forex brokers make money by charging a spread on each trade that their clients make. The spread can be fixed or variable, depending on the broker. Fixed spreads remain the same regardless of the market condition, while variable spreads can widen or narrow depending on market volatility. When choosing a Forex broker, it's important to consider the spread they charge, as this will impact the cost of the trading. A lower spread can be more advantageous for traders, and it reduces the cost of the opening and closing positions. However, it's also important to consider other factors such as the broker's reputation, regularity compliance, and trading platforms offered. In the description section below the video, you can find a few brokers that I'm offering and currently using. They have a great reputation and offer low spread costs. I have been using them for a while and they have been amazing for me. Also, one more important thing that traders should also be aware of the impact of spread on their trading strategies. For example, a scalping strategy that involves making many small trades with tight stop losses may be more sensitive to the spreads than a swing trading strategy that involves holding positions for longer period of times. In general, traders should aim to choose a broker with a competitive spread that aligns with their trading strategy and risk management goals. Moving on to one of the last topics, which is understanding leverage. Let's move on to leverage, which is the ability to control the large amount of money with a smaller deposit using borrowed funds provided by your broker. For example, with the leverage of 100 to 1, you can control a position of $100,000 with a margin deposit of just $1,000. Means that if the trade goes in your favor, you can make much more larger profit compared to your initial investment. However, leverage also magnifies your losses if the trade goes against you. Therefore, it's important to use leverage responsibly and to have a solid risk management strategies in place. And the last topic which we want to talk about is managing margin. The amount of margin required for a trade depends on the leverage that the trader uses. For example, if a trader uses a 100 to 1 leverage, they would only need to put 1,000 of the margin to control a position worth $400,000. However, high leverage means high risk, as losses can accumulate quickly if the trade goes against your trade. Margin requirements can vary depending on the broker and the currency pair being traded. Margin can also be referred as the used margin, which is the amount of margin being used for open trades, or free margin, which is the amount of margin available for new trades. It's important for traders to manage your margin carefully and to always have enough margin available to cover potential losses. Brokers may issue margin calls if the trade account's balance falls below a certain threshold, requiring the trader to deposit more funds to cover the margin requirement. If the trader is unable to do so, the broker may close out their trades to limit losses. And once again, we are back to my trades, and as you can see, my margin level is going up and down, depends on my trades and their losses or profit. Just want to tell you, if the margin level drops below 50%, the broker closes the biggest losing trade. So we finally reach the conclusion. To become a successful Forex trader, it's important to have a solid understanding of the key concepts such as pips, lot sizes, spread, leverage, and margin. Pips represent the smallest possible price movement of the currency pair and are essential in determining the profit or loss of the trade. Lot size allows traders to control the amount of currency they trade and manage their risk more efficiently. Leverage allows traders to control larger positions with a smaller deposit, but it also magnifies the risk of losses. Margin is the amount of money required to open and maintain a trading position, and it's important to manage it carefully to avoid margin calls or potential losses. By understanding and using these concepts effectively, you can increase your chances of success in the Forex market. Thank you guys so much for watching. Smash the subscribe button below, and I will see you in the next lessons.